Bill Holleran here. Thanks for the indulgence last week as I made sure that I wasn't passing on the COVID variant that we ran into. Interesting workup this morning. Last week, of course, we talked about all of the ways to have access to capital. Today, we're going to talk about the measuring system, the financial system that's necessary for you to be able to track your business. This is how we keep score in business. And these financial statements are the things that you need in order to be able to attract money, go out and raise money, and then track your business. It's fairly meticulous activity. I've broken it down to some real critical components, but Tiffany and I decided that during the course of today, if you have an immediate question, fire it to her in chat, and we'll take that question right away. And of course, I'll leave about 15 minutes at the end for questions with all individuals. So with that, let's start talking about the financial elements. The let's see, Tiffany, I'm not moving here, so that's it.
Because you have the wrong one. Sorry.
Had to admit something. That's it.
Yeah.
So this is the agenda. We're going to walk through the basic financial reports, and I have broken this down, recognizing that we have a fairly diverse group between full-time startups where we'll spend most of our time, because even if you are a part-time startup, you may aspire to full-time startup. But I've got a fairly easy and low-cost activity for those of you who are just starting with a part-time effort. And then we'll talk about the significance of those of you who have a high-growth startup at the end, because the financial requirements for you to get access to capital are that much more important. So ask questions as we go, and we'll proceed accordingly, and we'll talk about some additional resources at the end. I met Ms. Shaw, Cameron Shaw, at a trade conference actually a few months ago. She was part of a group that was overseeing a book called Atomic Habits, which if you ever have a chance to read is very, very good. But she has a great quote that will get us into the day. I tell people this is important when you talk about finance, because this is about budgeting, this is about money, this is about keeping track of your business and building the system to do that. There's no way around it. She has a great quote for that. She says, vision, your vision for your business will only take you so far. You don't rise to the level of that vision, you default or you fall to the level of your system. And that means that when we start to do the financial system, it gives you the grade and the numbers to let you know that you are actually making money. So it's important that we get this system right so that you have a great chance for success at your business. Just a great quote, and I'm sure I've used it any number of times. Here are the basics. When you talk to bankers, when you talk to investors and things like that, you'll hear this term financial pro formas. Pro formas is just a fancy word for projection. And in the end, I always tell people when we start to talk about financial statements and things like that, there is nothing that difficult in business other than getting the system in place. In the end, we're talking about adding, subtracting, multiplying, and dividing. There's not any of that we can't do. It's not high-end calculus or anything along those lines. But there are some standard formats that are used. The most important of which, where we'll spend most of our time today, is on the profit and loss statement. They also call that, in accounting terms, the income statement. We'll spend a little bit of time on the balance sheet because some of you will need those. And then you'll find that once you know how to do a profit and loss statement, your cash flow statement will fall into place, and I'll allow you to do that. We'll also cover how you can start after today, as we go through the rest of the course, looking for startup cost and things like that, so that we know what we'll be able to do that, what you'll need to be able to do that. And then this is a bane for Bill Holleran. In the end, I want each and every one of you to think about what is in this business for you. At a minimum, okay, that means that I want you to be able to have a salary. It is possible you may not take that salary from the start. but I want you to determine what you want it to be. So we build it into your cost so that you don't start to suddenly get an increase in sales, but you haven't taken into account what's in it for you. So I always want to make sure that we talk about your living expenses and build up from there, and then ultimately a salary from the owner. And you'll see that in the financial statements as we go. So let's start with the full-time startup. And what you see here is the initial column for a profit and loss statement. I'll bet my bottom dollar most of you have seen something like this in your life. And those of you who have initially tried even at startup ahead at your business, you'll run into this. You can see my left-hand column at least is the start of the categories that are necessary for your business. The most important one is the top line, okay? Sales estimates, because you're a startup, you're going to have to estimate what you're going to do in terms of sales. And for starters, to do a projection, I suggest to people that they try and do that on a month-by-month basis. So sales is the top line, and that's the money that you're going to take in based on the products and services that you offer. The second line item there is cost of goods. Some of you, for example, if we have folks in the group that are going to make things, you will need to acquire things in order to make your product or even to give your service. And you will want those things broken out because you know every time you make a sale, you're going to have to spend that money. So Tiffany Richardson is here, and she's a business analyst in her own right for artists. And she would make you break down all of your costs to produce your painting so that you knew that you were taking that into account in the price that you often come to your thing. On another level, we might have an individual, for example, that makes small pieces of furniture or something in the group. So you would want to line up what it costs to build it, the wood, the supplies, and all of those sort of things. And that's what goes to your cost of goods. And after you take that out, there's a gross margin or a gross profit left over. All your other expenses that are not associated with making the product, okay? The things that go across everything. You use it to make product, you use it to do your financials, you use it to pay your employees. Those are what they call in accounting terms SG&A expenses. It stands for sales, general, and administrative expenses. You all have undoubtedly heard the term overhead. So just think of it in that way. What's critical here is that you know these costs. If you don't know these costs, you take the chance of pricing your product to where you cannot make money. So once again, we break those down and we put it on a month-to-month basis. And you can see here, there are a variety of those. The wages you might have to pay an employee, the wage for you as the owner, okay? Make sure we give some thought to that. Once again, I recognize you might not take that right away. You might reinvest that in the business, but I want it built into your projection so we make sure that it is included in your prices. And then I've just listed a series of them. For each of you, you will want to build this initial column on your own. I put in things like rent and utilities and insurance and money for accountants and that. But this list could get to be 20 or 30 line items long, depending upon how sophisticated your business is. So as you think through that, make sure you take that into account. And then in the end, we have profit. Okay, so profit is the money left over. I always call it net profit for tax. If you have a net profit before tax, that means you're making money. And that's money that you can do one of two things with. You can reinvest it in the business. Actually, you could do three things with it. You can reinvest it in the business, you can put it in your pocket, or what you'll probably do is a combination of both. So that's the profit, and you'll have to pay Uncle Sam a little percentage of that, depending upon how sophisticated and how creative you and your accountants are. That's a profit and loss statement, also called an income statement. It is the core of being able to have a financial system that tracks your business. And so then what we do here is we take this and we go one step up. This is what I want you all to be able to accomplish. This is a 12-month projection. So when we're thinking about starting a business, what I want you to be able to do is look out 12 months and think about your business and then start building in these expenses. This becomes your annual budget or your annual plan or your annual spending element. You'll see in a minute, it's necessary to be able to raise money. In other words, if you're starting a business and you walk through this process, you will have a document that you can present to a bank or an investor that should be able to show them whether or not you can repay it. The other part is I just believe there is an immense value, particularly for those of you considering a full-time startup, to write this down. It allows you to look at real numbers. It sets goals once you put those numbers down, and it allows you to assess the risk in starting your venture. So it's a 12-month projection. I want you to do those initial columns and then project out 12 months. And so let me give you a taste for what that looks like. Okay, so this is Start Enterprise, a real creative name by Bill Holleran, you'll undoubtedly say, but you can see this is what one looks like in startup phase. Okay, so this is an individual entrepreneur who sat down and said to himself, how many sales can I do in my first month of existence? Okay, and in this case, the number turned out to be $6,000. Now, there will be people online and probably people here in the audience, you're quite correct. I can build an Excel spreadsheet. I can make it say anything I want, okay? But for this seminar, okay, when you start to do this exercise, that number has to be real because that becomes your sales goal. So it's one thing to put down a number that makes the spreadsheet work, okay? But in month one, that becomes the sales goal for what you want to think. So that's how you want to think through your business. You want to think through what can I do in the first month? What am I going to charge? How many customers am I going to have? That comes to a sales total. And then if you look at your first year, you can do month by month. Here's what I'm going to do the first month. Here's my goal for the second month. Here's my goal for the third month, so on and so forth. And so you can see here in this individual, he thought he could make, I actually like this projection. This is a real one that a client allowed me to use. I liked this one because it was reality based, and you can see he didn't say he was going to go from $6,000 to $100,000 in 2 months. When you think about trying to do that, that would be a lot of sales and a lot of expense and things like that. Not impossible, but he just gradually ramped himself up over the course of the first year. In this particular thing, you can see his cost of goods. His cost of goods was 50% of sales. So every time he made his particular product, it cost him $50 or cost him 50% in terms of profits. And that cascades across there. And then, of course, you can see his gross profits. And then you can see what else happened as he walked through the seminar you're experiencing here at NSUIC. And he started to put down his other expenses. He determined he needed an employee. And in this particular case, he decided that for the first year, he was going to pay that employee $30,000. You can see that in the total at the end. He determined his own owner's salary, okay, at a minimum. I'm a proponent. I often have folks in startup mode, like the folks here, the folks online. They'll ask me, well, what's a good starting salary? And I have an absolute minimum. It's $30,000 a year, okay? And that's only for the first year. That's not enough. That's not where we want you to end up, but it is a reasonable amount of money to build into your pricing and your cost structure. In this case, he settled on $2,800 a month, so you can see what that adds up to. And we knew we had a price built into it. And you can see the business was centered on him and an individual employee for the product he made. We did payroll, taxes, and benefits, which I think are probably around 15 or 16%. And now you start to get into the things that are variable, okay, as opposed to coming up every due. So he had rent. He actually needed a small facility, and he found a place for $1,500 a month. The utilities associated with that. And now you can see, if you look over the year, he actually budgeted warmer months and colder months. So he knew, based on talking to the folks that he rented from, what the variation was going to be over the course of the year. So that expense is not the same every single month. So he did his best to estimate that. And the expense went up as his sales went up. So remember, as you start to do sales and you start to make money, some of these expenses will not stay fixed. And as you're walking through this exercise, that will become apparent to you. He had to pay insurance, commercial insurance twice a year. Sometimes insurance is broken down to a monthly cost. And then you can see the money he spent on marketing promotion. He spent about $300 a month. And then twice a year, he went, or he planned to, and he did. He's still in his first year, but he plans to go to a trade show. And the cost of going to that trade show with travel and everything was a couple $1,000s. And I think that you'll see in here, it's in a couple of months. Then there are the professional services. These are the accountants and the lawyers that you might need. He had to spend $1,000 up front to organize his business and to get some contracts put in place. Somewhere in there is month 4. You can see that's when he had to pay his tax return for his accountant. And then he built in some money to use principally with his attorney in case he needed contracts reviewed with individual consumers. So you can see going from this is the I'm sorry. If I go back, right? You can see this is 1 month, okay? You build your chart, okay, of your expenses as it's unique to your business, but generally in this order: sales minus what it cost you to make the money, and then all of the other expenses down to profit. That's how our profit loss looks like. And then you can see this is the 12-month variation. So we take that chart of accounts and we look to project out 12 months, and then you can see the flavor of what one looks like once you have done it, okay? Now, keep in mind, once you get to this stage, this is a real live projection. And if you are a full-time startup, you have essentially set goals for yourself, okay, to be able to make your business successful. In the end, he's on track. As I told you, the individual is still in his first year, but he's in his 9th or 10th month. He has a business that showed a small profit after the first year. You can see on the bottom there, it took him a while to get there. He wasn't making money for the first couple of months, but generally as he got his sales up, he was able to do that. And if he continues on the track that he's on, he will make money by the end of the first year. Let me stop there. Anybody, all that clear for everybody? You can see, there is a totals column down there on the end that gives you a feel, and that bottom right-hand corner shows you his projected net profit for the year, okay? But this was the initial project he did, the initial projection he did before starting his business. I'll stop there and see if there are any questions that anybody might have.
Can you use this projection sheet for seasonal businesses?
Yes. So what would happen, you can see a little bit of, you won't see it much here, but the answer to your question is yes. That's why you want to look out over 12 months. It is completely possible that many of you may have a business that 3 or 4 months of the year makes $20,000. Imagine if you were doing business down at the Virginia Beach resort front, okay? From April to October, there are 2 million visitors. And then all of a sudden, after October, there aren't any more visitors. So you're dependent on the local population. So you might make 70% of your sales in a 4 or 5 month period, okay? And then your sales will drop off for those other periods. Or it will tell you, I need a real good marketing program to attract the local folks to keep them up. Those are the kinds of decisions that you can make by looking at a seasonal business. And then you're right, when you did the months, you would want to project that way. You would want to look and say, if I started in January, okay, when I get to March and April, my sales are really going to ramp up, okay? But in October, November, December, January, February, and probably most of March, at least in Virginia Beach, those sales are going to go down. And the reason it's important, as it's a great question, whoever asked it, is you can see these, some of these expenses will stay the same, okay? Your rent will probably be the same. It's a fixed cost. Wages for employees can be variable. You could hire seasonal talent or something like that for the high period and then just go back to a core staff. So you can see, once again, the value of this financial system is it allows you to make those decisions and adjust. Make sure I answered his question. Good there? Mm-hmm. Good there? Mm-hmm. Fair enough. So you can see the importance of the system. For me, this initial build out of your first year is critical, because if you walk through this step by step by step, you're telling yourself what you're going to need to do to be successful in those first 12 months of operation. It gets pretty hard to start predicting out beyond 2 years, but this is a great place to start. And remember, I encourage you as you do this exercise that you are actually setting goals for yourself, okay, and determining cost. And that gives you the ability to monitor your business for success once you actually start operations.
One more question.
Sure.
That projection sheet, is that also based off of historical data, or is that based off of forecasting?
Now, actually, with this group, I'm assuming most of the folks are startups. So in this case, you are walking through what you expect to happen in that first year. Now, in fairness to the person's point, you may be in a business that other people do, and there is historical percentages of what those might cost. If you think you're one of those businesses, then just tell the individual just to contact me directly.
Okay.
There are some studies, Robert Morris studies, there are some NAICS codes, which will give you sort of a good idea of what the percentage of each line item is. But for me, this is a projection that you walk through and think through yourself. What is my marketing plan going to be? Who is my target market? How many sales can I make? What is the cost to service those sales? And then let me build out all the other expenses that I encounter. Okay, so I'm assuming most of you are in startup mode. And so I don't want to use historical data because you really don't have any. In fairness, knowing there may be an existing business or two in the room, they're 100% correct. You could run a 12-month projection for your previous year, and you would have great historical data on which to project the next year. So the thinking there is correct, but I'm assuming most of the group here is in startup mode. So you're actually trying to walk through what your first 12 months will look like.
Okay.
Fair enough?
Mm-hmm.
Okay. So then this is the, so this then is just once again going back to the top. Okay, as you see here. Here's sales, you can see the top. And remember, once you write these down on a spreadsheet, those in this class who are going to start up, you are setting a sales goal. So this isn't making a spreadsheet sing, okay, and say what you want it to be. You've got to think, how am I going to get to $6,000 in sales, okay? How much is it going to cost me to produce those $6,000 in sales? And then you'll find out as you walk through the course, you'll encounter all of these other expenses and you can build your own P&L, but then you're going to need to cost and estimate those. Employees, you estimate by hourly wage or salary, and the other things you'll determine based on your own individual element. But you can see sales and goals for 12 months, the sales and general administration, and then profit. And as I said, in this case, you will see down there, accountants always put a lack of profit in parentheses or in red. So you can see for the first couple of months, he was not making money, but it does appear, because I happen to know he's on projection, pardon me, that he will be making money by the end of the year if he keeps making this project, progress. So the other part I wanted to tell you here is if you talk to anybody about using a profit and loss, what they will tell you is the most important part for any business is cash. It's one thing to make a product, then you got to get paid for it, okay? Now, for many businesses, say a restaurant or something like that, you provide the service and then people pay you right away. So cash flow is not really an issue, okay? You get paid that day and showing it in the month it appears. But there may be any number of you, for example, some of you may be considering going into government contracting. You may perform a service, okay, for a government contract, and you do all of the work, you spend all of the money, then you bill the government, and the government pays you in 30 to 60 days, okay? So now we've got a little cash flow issue. If you use your profit and loss and simply move that sales line item into the month that you get paid, you'll see what the cash implications are from that. So it's why I like the profit and loss statement. It very quickly turns into a nice cash flow statement for those of you that might be paid 15 to 60 days out. And then, of course, for any of you, you can see even this individual do it. Like insurance, he only had to pay at the start, and he paid it 6 months. He was paying his commercial insurance policy twice a month. And you can do a cash flow statement by simply putting your expenses in the month when you have to pay for them. For example, I know in this individual's case, he was going to do a trade show. That $2,000 is actually the cost to go to the trade show and his travel expenses, and he put it in the month when he was going to pay it. And I know there are two of them in there. So keep in mind, this is an income statement, and it readily turns into a cash flow statement for those of you who are going to be paid something other than not right away or in less than 15 days. So there are lots of businesses that get paid right away, but there are lots of businesses, particularly those of you considering doing business with the government or doing businesses where other businesses where you do the work, you bill them, which means you are due the money, you have a legal right to the money, but they have 30-day terms with you or 45-day terms with you, and they don't have to send you the check until that time frame. That shifts that sales number out a month and can have cash flow implications, and your P&L can allow you to do it just by making that adjustment. Let me stop there and make sure that. And that's when you hear people talk about cash is king. That's what they mean. It's for those of you that don't get paid right away, and we have to do an income statement that reflects the cash flow element. We good shape then? Very good. So then, for those of you doing startup, what goes in that first month? Okay, these are a list of startup costs. These are fairly typical. Okay, some of you may be running services businesses, so you won't have a whole lot of inventory or a whole lot of cost of goods, other than you might be hiring employees to do what you need to be done. But for those of you who are not a pure service business, you're a retail business, or you're building things, the initial inventory is something that you will need, because the inventory is what will generate your sales. And you're going to need to know that up front, because that's going to be financed in order to be able to open your operation. Many of you will have equipment needs. I actually, here I'm talking about a major piece of equipment that's unique to your business. If it's things like copiers and things like that, I put that under that furniture and fixture category in the fourth category. For those of you who are not home-based or part-time, you are going to find that rents and utilities usually require them, like when we rent our apartments or something like that, they require you to pay a deposit up front. Okay, so once again, even before you start, there is money that has to be set aside for your business. You will want to project out social media advertising and promotion costs. Occasionally, your home or your location is not ready for occupancy, and it may be depending upon how you, it may depend on how you negotiate with the landlord, what they will do and what they won't do. And then we have organizational costs, legal for setting up your business if you need that, accounting for helping with your financial system, and make sure you get the answers to your tax questions. And then, of course, you might have to budget a little money to do soft openings, particularly those of you who have retail outlets. Often restaurants do a soft opening before they actually start operations. You actually bring the employees in, you train them, you give them access to customers, but because you want to create a learning environment, you give a break to the customers, knowing that you are trying to work things out. Remember, those are all typical startup costs, and you'll want to know those up front and what they add up to, so we know how much it's going to take to start your business. And then owner's living expenses. So here's how I build your initial salary. I do recognize, in fairness to families and things like that, I've known innumerable entrepreneurs who have the fortune of having a spouse or a significant other who is handling the home expenses, okay? So they don't have to worry about living expenses. But for those of you that are not in that situation, I just want you to know there's nothing harder than starting a full-time business and worrying about whether or not you can pay the bills at home, okay? So when I start looking at the salary that you need to live, I just take a standard living statement, and you can see here, I don't think I left much out here, from rent all the way to what you might want to spend for fun and games and other things. These are the typical expenses all of us encounter in a day-to-day lifestyle. You add these up so you know what they are monthly, and at a minimum, I want you to add this up, and that will be the basis of your salary. If it doesn't add up to $30,000, mark it up to $30,000 if you are a full-time startup, because I want to make sure we have a significant cost element in your pricing structure that is beginning to cover a owner's salary. So this is just a real standard list about owners' living expenses. And as I said, I hope I didn't leave anything out on that. So when I work with startups, the question always, as we started with almost the first slide last week, is how much money do I need to start? Okay. And so the first question I ask is, are you going to own your real estate? The answer to that for most of us is no. Okay. So it's just going to be a rental expense. Then the second thing I want to know is, do you need any specialized equipment? And if there's a cost to that, I add that up. Then I have a tendency to group everything else into a category I call working capital. And people always ask, what do you mean? And you can see here in yellow, that's what I mean. Those costs in yellow are working capital expenses, okay? And that is probably what you need to start. There is a great rule of thumb that has developed based on studying successful small businesses that says you give your greatest chance of success for a full-time startup by having 3 to 6 months worth of working capital. So you can see if you do your projection, one, you will be able to project that expense. In this particular example, in yellow, I show you 6 months worth of working capital. You can take those yellow areas, add them up, and you would know how much money you need to give yourself time to ramp up to profitability. Now then you can think through. I see lots of small business owners who say, I don't need 6 months, Bill Holleran, all I need is 3. And that's all fine and dandy. You can see in the situation though, that means you've got to get to profitability. And that means that this chart, you would simply narrow to 3 months. But when you look at working capital, if you've done your projection, you can see you can go right to this projection and look at your expenses and get a good read of how much money it will take for you to start. And then the rule that has developed in studying successful small business startups is 3 to 6 months worth of working capital expenses, along with equipment, inventory, and if you're buying real estate, is a good way to put together an equation on how you are going to start. So that is the 3 to 6 month effort. And you can see all of that comes from walking through and putting a system in place to do your initial 12-month projection. Fairly meticulous work. I don't think anything I did in the past few slides is anything anybody online or here in the center would determine that they couldn't do, but it requires forethought. But once you have it down, you have set goals from yourself, and it begins to answer the questions you need to determine whether or not you can be successful with your startup. Let me stop there, Tiffany, and see, are there any questions?
Nope.
Very good. Anything from you guys, okay? Very good. So when we leave a profit and loss, the other financial pro forma is a balance sheet. A little more complicated. A balance sheet is simply assets minus liabilities is what you are worth. And we'll go through a couple of the categories. Many of you may only need a balance sheet run once a month. For me, the profit and loss is something that I want to see every single month. And actually in startup mode, I'm probably looking at it every week or two, okay? You, however, may be a business that has significant assets, like lots of equipment that has to be watched, or inventory, okay? And you can see here, this is an example of that. The left-hand side is the assets of your business. You all will know, you certainly are familiar with cash as it goes through the business. Accounts receivable is for those of you that get paid out, like we talked earlier, on a government contract. You are owed the money, you did the work, but at the time you took a picture of this balance sheet, it had not been paid to you, so they wouldn't put it in cash, they would put it in accounts receivable. Many of you will have inventory and supplies and things that are necessary to make your products. And then prepaid expenses are things like insurance that are paid ahead of time. And intangible assets are for those of you, particularly, I know that for a fact that we have some technology startups in the room. If you're using patents and trademarks and things like that to protect your product. Intangible assets will have a value based on you setting them up, and they end up on the balance sheet. Fixed assets, you could guess, would be your equipment and furniture and fixtures. They are placed on a balance sheet at what you pay for them. The right-hand side, or at least my right-hand side, are then the liabilities. This is what you owe. Okay, so assets are what you own, and liabilities are what you owe. And the accounts receivable are the people that you have out on time. Okay, so the government's not paying you for 30 to 60 days. So you went out and got one of your major suppliers, okay, to give you terms for 30 to 60 days. So it matches up. But once you've completed the work and used their material and they billed you, you actually owe that amount of money. That's what an accounts payable is. You may have some short-term loans. We always want to keep track of our taxes so that we can pay them when they're due. And then long-term liabilities, some of you may start a business and you may get a loan from a bank, from a government loan, or what we were talking about last week. And we would put that on your balance sheet, and it would gradually work its way off over the course of the years. And then, of course, there's owner's equity, the investment you make in the business, and then retained earnings is the profit that comes out of the business. And as the accountants will tell you, both sides of these should balance, okay? So that's why they call it a balance sheet. This is what you owe, this is what you own, this is what you owe. And that owner's equity element is a good place to start to determine how much your business might be worth in any place in time. This is a fairly simple one with small numbers. Actually, the accountant do this will tell you everything has 3 zeros on the back of it, but that's a balance sheet. For those of you in pure service businesses without inventory and things like that, a balance sheet may be something you want to run once every quarter or something like that, okay? But for those of you who have assets, inventory and equipment in particular, a balance sheet like your income statement is something that you look out every single month. It's a snapshot in time, and you'll be able to watch the flow of your business and to make sure that you know where all your assets are, that you're being paid, and that you're paying everybody. See, so for the full-time startup, these next 2 slides are the elements of what a financial system looks like, and now what your personal responsibilities will be with regard to running your business, okay? Now, what's important here for all of you is some of you may have a bookkeeper, or you may say, you know, Bill Holland, I'm not the greatest at finances. There's no problem with that, but you have to understand your system, and then you can delegate this. But these are the things that an owner wants to be aware of on a daily, weekly, and a monthly business, particularly with a full-time enterprise. So I like people to build this into their time management system so they make sure they're looking at their financials, and this is what you look for, okay? So on a daily basis, you make sure you handle all the cash. If you have a business that's taking in cash, you make sure you handle that, it gets counted, it gets allocated into your system, and it gets off to the bank, okay? You always want to be able to look at your bank balance, and now we're talking about a business, so now we want a financial system that's separate from your personal life. Your owner's salary or your distribution is how you transfer money from your business into your personal life, if you're so inclined, but the bank balance is something that you can watch to make sure you know how you're doing. On a daily basis, you always want to know what sales, cash, and receipts are. You want to have a nature about double checking for errors so that that comes out, and you make sure that you develop a financial system. Most of this can be automated or delegated to a bookkeeper, but so you record all of these activities. These are things that a good small business owner does on a daily basis because it makes sure you're maximizing and keeping track of what happens in your business on a daily basis. The things that you have to do weekly, for those of you that have folks that are paying you in 30 to 60 days, accountants or bookkeepers will teach you to do an accounts receivable or an aging report, okay? And here you're looking for past dues, but you get a report once a week, you look at it. Gee, this person has owed me money for 28 days. My contract says they're supposed to pay me in 30, we're okay. This person says they're supposed to pay me in 30 and they haven't paid me for 45 days. I'm on the phone. okay, that day to find out what the holdup is and to get that situation corrected. Most small businesses pay their bills once a week, okay, on time. And you'll find from time to time that for paying early, okay, you may get a discount. So you take advantage of those if the vendors and that are using are doing that. Then you have to run payroll. Generally, at this day and time, payroll can be run anywhere from, you can pay people daily all the way up to a month. I believe in Virginia, you have to at least run a payroll once a month if you have employees. Most people, of course, do it on a weekly or on a 2-week basis. Independent contractors, people who are working for you that are not pure vendors, but are not permanent employees, where you're giving them freelance work, will have to be paid based on the contract agreement with them. But you look at that as you're paying other people. And then do this, beware of this. Make sure you build your reserves for states and federal taxes, okay? So the first thing is every week you do payroll, you'll have payroll taxes. That's no longer your money, okay? You put it over there on the side of your bank account, and when your payroll taxes are due, okay, and payable to the federal government, you know the money's sitting there and you write the check. And then, of course, you're consistently setting money apart based on whatever your state and federal liabilities will do. And then on a weekly basis, you always want to look at your financial system and look at your inventory requirements for your upcoming work and make sure that that money is flow, or that you're buying that inventory for next week's work so that you can actually get the sales that it will command. Those are the daily and the weekly activities for a solid financial system for a full-time startup, okay? Now then there are just a couple of others. Monthly, now you want to look at your system and make sure it's accounted for everything. So once every 30 days, you sit down and you run that profit and loss statement, okay? So we did the projection. Now we run the profit and loss showing what actually happened. We compare it to your projection and we see if you're on plan. This is how you run a business and make sure that if you projected a profit and you are running close to those numbers, that the business has a chance of being successful. I like the 12-month budget profit process. I actually like a column for actual. I like my initial projection next to it, and I like it month by month by month. So then I can just run that. And that's how I make my system work. That's how I've always run my business. They call that a deviation to budget report in the accountants. You may or may not need a balance sheet. As we discussed, you do reconcile your bank statement, particularly in startups. I always like the owner doing that for a while, because before you delegate that, I want you knowing that that bank statement is coming back whole. So it's just one of those nice things to sit down and do and just make sure that everything that said it got paid that way actually went through the bank. And then take care of your federal tax deposits. Please be aware of this. When you're at startup mode, the tendency can be, because that's real money coming in for taxes, is not to set it aside, okay? And you act like it's part of your cash flow. Then you have a small downturn in the business and you use that money for cash, okay? It's not your money, okay? It's not for the business. Now, the trouble is you go by a day, the taxes were owed, and the trouble is the taxing authorities will not call you the next day and say you owe us money. They'll wait till it adds up to something. And the trouble with our taxing authorities is their penalties are usury. There's no two ways about it. So you get in trouble with the IRS or with the Department of Taxation for the state or something like that. Generally, when they come calling, it means you haven't been paying taxes for a while, and they tack on penalties and things like that that can be pretty significant. And I simply want to avoid that. From a standpoint for those of you considering a full-time startup, if finance is not your thing, you still need to understand this, okay? But you can hire a bookkeeper and delegate this out as long as you have a full understanding of this system and can monitor it, as we've discussed on the past 2 slides. It is an essential practice, I believe, for a full-time startup, okay, to hire an accountant. You don't need them every day. You certainly need them to keep track of the tax system and do your tax system. And the best CPAs get to know your business, understand how you make money, and they may become a very, very valuable professional affiliation. And then, of course, some of you may be very adept at handling all this yourself up to a point. I actually did a study with a couple of accountants too many years ago on this system that I've laid out in the past, in the past two slides. This can be done in 2.5 hours a month, okay, if your system is automated and all of that. So it doesn't have to be an inordinate amount of time, as long as you know you've got good data going into it. So it is possible up to a point to handle this yourself. For the other full-time startups, you start getting beyond yourself and say 5 or 6 other individuals, you may have better things to do. So it might be time to hire a bookkeeper and delegate this out, but delegate the system that you put in place, okay, to do that. Then it's one thing to do the financial projection we talked about at the start, but in the end, no projection is going to be 100% correct. So for me, I always want to relook at my projection every 3 months to see how I did. And I add the next 3 months for a 3-year. And that's how I plan going forward. I've had good luck in my career. I've seen lots of small business owners who could legitimately project pretty well 3 to 6 months in advance. And and I just think it's a good idea. And there's lots of data on successful small businesses who at least try to see 6 to 12 months ahead. Let me stop there, Tiffany, and see if we have any questions.
There aren't any questions, but I did ask everyone online how they currently keep track of their finances. And half of the people said that they do it themselves.
Yes.
The other half of the people said they use QuickBooks.
Yes. So if you're using QuickBooks and you haven't delegated the system out, remember, in the end, all QuickBooks is a system. You can operate it yourself. You can have your bookkeeper operate it for you and produce the reports that we've talked about for the past 50 or 55 minutes. So for me, QuickBooks is just one of it's a dominant system. It has a significant share, and it's a very, very good system. It's not the only one out there. But to me, QuickBooks is just the system. For those of you doing it on your own, have absolutely no problem with it. You're probably saving some expenses. It's just, remember, for the first part of this presentation, we were talking about a full-time startup. And as your business gets traction and you do more and more sales, you will find there are more and more important things for you to do than bookkeeping. So I believe at some point you will need to delegate the responsibilities to a bookkeeper. And if you get large enough, start getting yourself into the 10 to 50 employee range. It's not unusual for a management team to have an accountant or someone on place. The one exception to all of this is I know that we have some folks online and maybe here in the center who may be high growth startups. If you are a high growth startup with a technology idea and you're going to be raising significant amounts of money, you will need a financial person on your management team. So investors, venture capital funds, they do business not just with the initial owner, they do business with management teams, and a critical component of any management team is going to be the person who is looking at the money. So you usually have a finance person or an accountant type on your management team if you are a high growth startup. I think that answered.
There's one more question.
Sure.
What happens if you set up the wrong type of business and have no intentions of using it anymore and want to apply for another company? What effect does the tax filings have on an unoperated business?
Yes. Actually, in that particular case, I'm going to make you spend a little, if you've had that happen, I'm going to make you take what legal documents you have and spend an hour or two with an attorney and just let them tell you how to dissolve the business. Once you dissolve the business, okay, now you'll simply have to go at the end of the year and file a tax return. Your accountant will notify the IRS that has been that, and he'll be able to walk through the tax implications, whether you created a tax liability. You might have created a tax loss for you that could cascade with your other incomes. The best example, I had a real estate business that did not fare very well. Okay, we didn't lose a ton of money. We recovered most of the equity, but it took us 10 years to do it. And I was happy the day, along with 2 other partners, that we closed it down. Okay, and that's exactly the process we walked through. We just went to our attorney, we got everything, we sold off some final assets, we got everything set. He gave us the necessary legal documents. We went to our accountant, and in the end, we got a little bit of a tax loss carry forward, and we notified the taxing authorities that this business had been dissolved. So that's the answer. Then tell her, then start over your new venture. It's really that simple. I wouldn't do that on your own. I would spend a little bit of money with the attorney, the accountant, just so nothing comes back to haunt you. I like attorneys looking and making sure there's not any hidden liability or a workman's comp case or someone who sued you that hasn't been resolved when you actually dissolve the business. Underwoods?
Nope, that's all.
Some of you will have a part-time startup, okay? You're using this to augment income. For me, these are folks that don't plan on making maybe more than $30,000 to $50,000 a year. There's nothing wrong with it. I've had businesses like this. I've seen many people use it to augment income. And I don't want you to have to do as much work as is necessary. Still, the profit and loss is the critical element that I want you to build. So I want you to go through the same exercise of listing all your expenses. There's some good news generally. If you're a part-time startup, you see these elements in black, these go away. Generally, if you're part-time, you're home-based, you're not going to pay rent. That means you won't have utilities associated with that. You may be doing all of the work yourself, and you may delegate. Tiffany and I were talking earlier. There are lots of services out there from firms like Amazon and firms like them who do fulfillment, almost everything that in olden days we would have had to go find a warehouse operation for. So employee wages may go away. So you may have a lot less in terms of overhead expenses. Still, walk through this exercise and determine, okay, whether or not what your actual costs are. Because the best part-time businesses look at what they want to do. They project out their sales with all of their expenses, including something for the owner, okay? And they make sure that they can make money every time they touch their business, okay? So I get worried, for example, of say a business that says, I'm going to make t-shirts. If you're going to do it part-time, I want you to determine that I have to make 15 t-shirts, okay, at this cost minus these expenses, and there's $1,000 left over for me. I don't want you betting that you'll sell 15 t-shirts. So always look at your profit loss as a one-shot stop. Many of you may sell arts and crafts or things like that, and you go to trade shows. I want every trade show to produce a profit for you. That is the history of what makes successful part-time businesses, and you do the same. What do my sales need to be? What does it cost me to do the product? What are my other expenses? So you know your costs, but you may, as a part-time startup, have significantly less expenses than the full-time startup. So you can do things for a little bit less. And then I always want you to project something in it for yourself. I always call that an owner's salary, but I always want to make sure that there is something in your projection for you so that in addition to making profit, you have the potential to make some money off your time, and we don't leave that out. Generally, I have down there in white professional affiliations. When I'm a part-time startup, I try to avoid legal and accounting costs, okay? Generally, many of you, I bet we have some folks online have started one-person LLCs, which can be done pretty effectively online. I don't want you to get much more complicated for that. And if you're running a part-time businesses and you involve more than yourself as an owner, in other words, there are 2 or 3 of you. For me, now I start consulting an attorney, and I really wonder why I want to do a part-time business with multiple owners, okay? Because it just adds to the cost. You probably still once a year have to spend a little money with your accountant, but I had a couple of part-time businesses for 10 or 15 years and never did anything more than went to Jackson Hewitt and paid $60 to get my Schedule C done. So it can be very inexpensive. It can be done once a year as long as you track all your expenses. So once again, the idea here for the part-time business is for you to go through the same exercise, but don't look at it 12 months. Look at making money project by activity. And then once again, keep in mind, I think of part-time businesses as being businesses that do $0 to $50,000 a year. You start getting beyond $50,000 in sales, you've identified a market, okay, and that's good news. And you might be on your way to full time. So just keep that in the back of your mind.
Question on this.
Sure.
So for part-time businesses, instead of employees' wages,
Yes.
would you put freelancer? A freelancer.
Actually,
payment?
don't have any trouble with that. It is worth everybody noting online. Tiffany makes a very good point. So does the individual that asked the question. There is a difference between an employee and an independent contractor. The advantage of independent contractors is they are their own business, part-time or otherwise, which means they are responsible for the taxes. If you hire an employee, you have to pay at least a percentage of the payroll taxes for the employee. You don't have to do that with your freelancer. Hopefully your freelancer has gone through this exercise and has built payroll taxes into the cost that they are charging you. That's how that should work. The trouble that I want everybody to keep in mind and avoid is whether or not someone is an independent contractor or is an employee is not your call. It is regulated by law. The IRS has a 20-point test. The easiest one is rule number 1. If you tell somebody they have to be at your work, even part-time from 9 to 5, Monday, Tuesday, and Wednesday, you are controlling their time, and that's the first test. The IRS, the Department of Taxation, will tell you that's an employee. You cannot categorize that person as an independent contractor and avoid paying taxes. They will come back to you to pay that. So the individual is right. You can use freelancers, but make sure you tell them, this is what I want you to do. You reduce it to a contract. You give them a deliverable or a time frame, but you don't control their time. Those are the most significant tests there. So it's a great question. Independent contractors or freelancers can be used, okay? And it does avoid you having to pay the taxes as long as they are not classified as an employee. So that's a rule of law. If you want that, I keep a brief that I keep updated. You can tell the individual they can send me that. I've got the 20-point test that I think it's actually up to 24 that they use to be able to do that. And you'll be able to look at that and determine it. Some of it gets pretty esoteric. The real important one is whether or not you control their time. So it's an excellent tactic. Keep in mind, you don't really void the taxes if the freelancer is doing what we're talking about today. They have built their tax structure into the fee that they are charging you. Okay, but some people will hear people say, you won't have to pay their taxes. Well, not if they're not smart enough to include it in their cost, but in the end, whether someone's an employee or an independent contractor is a matter of law. It's not totally your judgment. So I'd want to make sure you knew the rules.
So do you put that expense on here on the profit?
I would. I would, exactly. And then you can see when we started this, in this case, I had cherry picked a bunch of expenses. In your case, you would have a line item not for employees, but for freelancers or for an individual vendor. You might hide it. So that's just the difference. Once again, this is not written in stone. This is a pretty good list, but if your list is different, there's no problem with that. That means you are taking into account what you will actually have to spend. Fair enough?
Mhm.
Okay. Part-time is essentially the same in terms of monitoring your business. It's just going to take it. So the financial system still has to be separated from your personal life. The daily and the weekly elements are all of the same, okay? The monthly elements are still the same, except I just want you looking once a month and seeing that you've made money, okay? With all of your sales and all your expenses, and you are still liable for your expenses and your federal taxes. What I do want to do is with staffing, I generally now want the finances for you to do it yourself. Okay, I want you to develop that capability because it means you don't have to spend money that could otherwise go into your pocket and be spent from you. I would once a year get the tax done professionally. I recognize there are some of you on board. I actually know people who are very good at doing their personal tax returns and have done them for years, and it can save you $40 to $200 depending upon where you go. But with a part-time business, a Schedule C is a fairly inexpensive activity that you can get done at a Jackson Hewitt or an H&R Block. I've just never been very good at keeping track of the tax code. And it's my experience that once business owners start to have some success, they've got better things to do than worry about the tax code. Let the experts tell you what that was. Handle the finances yourself. And then you can see here, my best practice over the years is the best part-time businesses segment their business into projects and activities, and they make money on every single one. Okay, and that gives you the ability to augment your income. Are we good there?
Mhm.
Then, what's not important, this is relatively simple before we go to Q&A, but I want to recognize that some of you are in this class in order to look further down the line to a full-scale accelerator program. And some of you may have very significant aspirations. You may have technology ideas and things like that, and you would think that you have a business that has real high growth startup. Generally, this means you're going to be raising money, if not debt, most likely financing. Your financial elements change pretty significantly even at startup. First of all, we talked about this earlier. You can see the first one. Now, people who put significant money into high growth startups want to see a management team, okay? They're not interested in part-time businesses. They want to see a management team, and the three core elements of a management team, and actually there are really 5 or 6 once you get into it. But everybody wants to know who the CEO is for with the vision. Everybody wants to know who the chief operating officer or chief marketing and sales individual is. And everybody wants to know who's the person handling the money, or the term they use will be a CFO. Okay, so a minimum management team for a high growth startup is those. I have never seen a high growth startup approach or get financing without having that management team knowledgeable to the investor and frankly part of their presentation. Usually people take presentations and put them in their pitch and identify who those people are. Systems and procedures will need to be in place. You get questions about that. They will want to know that you have identified who your accountant and your CPA will be, because they know you've got better things to do than build financial systems and track accountants. So they always want you being able to get that advice. And then for some of you, you may actually go beyond CPAs and engage part-time investment bankers or folks like that who can help you with raising money. Sometimes your CFO, that's the talent you want out of that individual. But those of us in this group that are a high growth startup, you can see we're talking about a full-scale management team, even at startup, in order to be able to go raise money. Then I just walked you through a 12-month projection, which is more than adequate, okay, particularly with quarterly look for part-time and for full-time startups that are a little slower pace. However, if you are a high growth startup, someone is going to want you to do a projection out 5 years. The reason for that is because you are probably trying to raise money. You are not going to pay back investors right away, but they will want to look out to years 3 or 4 and 5 and start to see how their money will come back to them, either through some sort of payment scheme or through an exit strategy. They'll want to be able to see over 5 years that you plan for high growth, and they'll want to see whether or not you believe them. And then you can see here in the individual components, the way you break that down. I have done a lot of work with high growth startups, and we still do the first year month by month to give that management team a feel for what they have to do it. But when we go to talk to investors, we tend to group things on an annual basis or on a quarterly basis because they can follow it on a annual basis. Your capital expenditures and all of that need to be broken out. It'll probably be part of the ask for money. And you can see, you may have people who want to know about what if scenarios. It's why you need a financial person on the team, because they can build models and answer those questions of investors as you try to raise money. The other reason is, for most cases, a high growth startup is not going to raise money one time. They are going to raise money in the first 3 to 8 years of their existence, probably 3 to 5 times. And so this is an ongoing activity. And so you can see the need for a very sophisticated financial system right from the start. You have to be able, that system has to show a demonstrable possibility of an investment grade return to the investors. And generally, they're looking for exit strategies. Lots of technology firms grow for 3 to 8 years. And then one of the ways they pay off their investors is that they sell, or they sell a portion of the business, or they sell it in total to a bigger enterprise. And that's a payday where everybody makes money, from the owners to the investors, if you are lucky enough to have that type of success. Many high growth startups stay the same. They keep the management team and they grow on. The investors stay around. I've not had the personal experience of going public, but you will read about startups that go over the course of 5, 10 years and eventually file an IPO. That's a payday for everybody as well. And plenty of high growth startups grow and just keep growing, and then they figure out a way to buy out or pay off investors as they have more and more free cash flow. Fair enough. Once again, don't want to leave any of these folks out of the room. I just wanted to give a real good feel to the group of the sophistication. For those of you who have a high growth or a technology startup in mind, this is the kind of financial system that you really have to build from the start. Questions, Tiffany? No, sir. Good. So then we're to resources. We visited this briefly last week. Okay. So now as we get into the ongoing weeks of the program, you can see once you build your financial template, you can start thinking about, what are my sales going to be? And that's what that first line is. Okay. My sales are going to be this level over the first year. Great question earlier about seasonality. Then think about it in 12-month increments. Will it be seasonal? Will it be automatic? A hockey puck straight up or something like that? What's the geography you're going to operate in, and the products and the services that you're going to offer? So now this week going forward, this is a good slide to take and start thinking about, because next week we start talking about marketing, sales, and customers. And so having an idea of your offering that we're going to build into this financial system is important. And then we'll talk more over the next 3 or 4 weeks about target marketing and that sort of thing. I always at this point like to talk about brand. Brand is real important for whatever you conceive or your vision or mission is. For me, I try to reduce brand to this statement, which was given to me by a first-rate Fortune 500 marketing executive a number of years ago. Brand is the promise of a customer experience that gives your firm a competitive advantage. You'll hear over the next 4 weeks, my constant mantra will be differentiate yourself. Okay, so competitive advantage is what you need. There's always competition, even if you have a great new and novel idea, because people are spending their money on something right now, even if you've got the new widget that may be better. And then once again, I don't want any of you to leave today's presentation without remembering there has to be something in this for you. I call it an owner's salary, okay? But I simply want you to make sure that you project that there is something in this for you, and that we include this in building your financial system and your costs. There are way too many businesses that do this full-scale financial projection, but they think, I'm not really going to take any money out of the business, so they don't build the cost in. Once again, I don't care whether you take the money right away. Okay, what I want to make sure is you built it into your cost so that we have a pricing structure that reflects at some point there is going to be money in this for the owner. That's one of the major reasons for operating a business. Fair enough. Then let's see, and then this is just adding on to last week. So for those of you who need individual questions, just send me an email or Tiffany or Yasmin, and they'll pass it on to me. I'll ask you to fill out a 641. We'll probably have a meeting and we'll talk through your individual questions, and we can do that over the next 8 or 9 weeks. Now, what I want you to walk out today is I want you to get out your Excel spreadsheets, or if you're manual, and let's put a 12-month financial template in place and start thinking based on your business what your expenses are. I don't really need you to do numbers now. As we start talking over the next couple of weeks, those numbers will become apparent as we talk about marketing and promotion, and you decide what you're going to do. That will have a cost associated to it. When we talk about hiring an employee, it will be, okay, how much is that individual going to do it? And you'll be able to project that as we go. But let's look at building out a financial template, particularly the full-time startups, so we start to take into account your cost and we have the makings of your financial system. I did tell you last week, and I know a couple of you took advantage of this, startwheel.org is just my way of getting you involved in the entrepreneurial calendar around Hampton Roads. It's worth a glance every week. Get yourself on it, okay? It's for free. They produce a calendar of everything's going on, and they have nice little things like millions cups of coffee. I don't know what you will find valuable. I just know as you look at the resources in the community, that Startwheel does a very, very good job of tracking those, and you'll be able to look at it. So take a glance at it weekly. If you have questions about anything, chances are I've encountered those resources. So just give Tiffany or me an ask. And then the other part of it is from time to time, you'll see presentations for new financial programs, occasionally a new grant program. And if those are applicable to, you can do that. And then, of course, you have my name, address, and telephone number. And with any luck, Tiffany, we finished right on time.